Greetings to all our listeners on StockExplorers. Welcome back to the deep dive.
Great to be here.
Today we're tackling Lumen Technologies. They're a pretty big name in tech and telecom, and, well, they're going through some major changes right now.
That's right. A real transformation underway.
Our goal here is to unpack their business, focusing on what potential investors really need to know. We'll hit the big AT&T agreement, their new push into AI and the enterprise space.
And we'll look at both sides, definitely. The upsides and the potential pitfalls, too. Plus, what to watch for down the road.
Exactly.
Yeah.
So let's jump right in. This AT&T deal that's been making headlines, can you break down the basics for us?
Sure. So essentially, Lumen is selling off its consumer fiber to the home business. That includes quantum fiber across 11 states to AT&T.
Okay, 11 states.
Yeah.
And the financials?
The headline number is $5.75 billion in cash. Now, that's subject to adjustments. You know how these things work. Lumen expects the net proceeds to be closer to $4.2 billion. And they're aiming to close this in the first half of 2026. But critically, that depends on getting regulatory approval. No guarantees there yet.
And any breakup fees mentioned if things go sideways?
Not publicly, no. Nothing detailed on penalties if one side walks away, which is, well, interesting in itself.
Okay, so $4.2 billion net, potentially. That's a lot of cash coming in. What's the immediate plan for that? How does it help their books?
Yeah, the biggest immediate impact is debt reduction. Big time. They plan to use those proceeds, plus some cash they already have, to pay down about $4.8 billion of what's called super priority debt.
Super priority, meaning first in line if things go wrong.
Exactly. Paying that down is expected to cut their annual interest expense by around $300 million. That's a nice chunk.
Definitely.
And on top of that, they shed about $1 billion a year in capital expenditures CapEx that they were pouring into that consumer fiber network.
Wow, okay. So lower interest payments, much lower CapEx. How does that flow through to their overall cash situation?
Well, you add the billion in CapEx savings and the $300 million in interest savings, and you get that figure they've mentioned, around $1.3 billion in annual cash flow improvement.
It sounds huge.
It is, but there's a key point here. That $1.3 billion doesn't account for the earnings, the EBITDA, from the assets they're selling.
Ah, right. So they lose the profit from that business, too.
Well, here's the interesting part. Lumen CFO has said they expect minimal EBITDA loss from this sale.
Minimal. How does that work if they're selling a whole business unit?
Because apparently that consumer fiber business was in heavy investment mode.
Yeah.
They were spending a lot to get customers and build out the network. So the operating costs were high relative to the current earnings. They're essentially cutting loose a part of the business that was dragging on cash flow, even if it had revenue.
Got it. So less revenue coming in the door, but potentially a much healthier bottom line from what's left.
That seems to be the plan. Their leverage ratio net debt to adjusted EBITDA is projected to drop from 4.9 times down to 3.9 times based on 2025 numbers. That's a significant improvement. The assets being sold bring in over $750 million in annual revenue. That vanishes. But the minimal EBITDA hit suggests they're prioritizing cash generation and balance sheet health over just chasing top-line consumer growth.
Makes sense. So what's the bigger picture here, the strategic thinking behind selling off this consumer fiber piece?
It really comes down to focus. The CEO, Kate Johnson, wants Lumen laser-focused on enterprise customers, providing the networking backbone for businesses dealing with multi-cloud setups, AI, all that complex stuff.
So free up resources for the enterprise push.
Exactly. Financial flexibility for that core strategy. The CFO also pointed out that, look, the consumer fiber market has a different investment profile, and crucially, Lumen doesn't have a wireless offering, which makes it tough to compete against the big guys who bundle everything.
Right, the bundle is king in consumer telecom. So they're basically saying, we can't really win here, let's double down where we think we can win.
That's a good way to put it. They're selling substantially all their words the mass market's fiber business. That's about 95% of quantum fiber. Covers around 4 million locations, about 1 million subscribers. Think Denver, Minneapolis, Seattle, big areas.
But they're keeping some core infrastructure.
Yes, and this is key. They keep the national and regional fiber backbone, the central offices, their existing enterprise and wholesale customers, and the copper network in the States not part of the sale.
Okay, so they still have the pipes to serve the enterprise clients, even in those sold territories.
That's the idea. They retain the underlying infrastructure.
Let's talk valuation. $5.75 billion. Is that a good price?
Yeah.
How does it stack up?
Well, it breaks down to about $4,437 per location or $5,750 per subscriber. Lumen has its own internal metric that's higher, but that probably includes retained assets. Some analysts, like New Street Research, suggested it was a pretty good deal for AT&T compared to other fiber transactions. And it was definitely at the lower end of what the market initially speculated, which was maybe $6 to $9 billion.
So why not hold out for more?
Lumen management keeps emphasizing the strategic win here. The debt reduction, the enterprise focus, getting the deal done and pivoting seems to have been more important than squeezing out every last dollar.
Strategic value over maximum price.
Okay.
What about the operational side? Any immediate bumps, or is it pretty straightforward?
Operationally, like we said, minimal short-term EBITDA hit because it was an investment-heavy business. The big operational win is avoiding all that future CapEx they would have needed for consumer fiber.
Right, the $1 billion a year.
Exactly. There are always potential, dyssynergies when you carve out a business, but Lumen hasn't flagged major concerns there. They will provide transitional services to AT&T for about 2 years to smooth the handover.
Okay. And AT&T's plan.
They're setting up a separate subsidiary for these assets, a network co, and they're actually looking for an equity partner to join them in that venture.
Interesting. And Lumen can still serve its enterprise clients in those areas.
Should be fine. They keep the backbone, and they can likely work out wholesale deals or use those transitional service agreements. This deal also maybe opens the door for Lumen to look at other divestitures later on.
What about their fiber supply deal with Corning? Is that affected?
No, that seems separate. That agreement secures fiber capacity for Lumen's broader build-out, especially for AI infrastructure, not specifically tied to the consumer stuff being sold.
And finally, the credit rating. Should get a boost.
You expect so. Reducing debt significantly usually looks good to the rating agencies. So yeah, potential positive impact there.
Okay, that's a really thorough look at the AT&T deal. Huge implications. Now, let's pivot to the other big piece. Lumen's new strategy, this focus on AI and the enterprise sector. What's the foundation of this turnaround plan?
Right, they've laid out 3 main pillars. First is driving operational excellence. That's the internal stuff, upgrading systems, simplifying products, unifying networks, improving sales, cutting costs. Standard turnaround playbook stuff, but important.
Makes sense. Pillar 2.
Building the backbone for the AI economy. This is about positioning their fiber network as essential for AI and hyperscale computing demands. High capacity, low latency.
And the third?
Cloudifying telecom. This involves their Lumen digital platform and network as a service, or NaaS. Basically, making network services easier to consume, more flexible, like cloud services.
Okay, pillars sound good. Are we seeing any actual progress? Any proof it's working?
There are some positive signs, yeah.
Yeah?
In Q1 2025, their North American business grow revenue, that's the strategic stuff they want to grow, was up almost 8% year over year.
That's pretty good.
And they reported the lowest number of enterprise customers leaving in 5 quarters, so better retention. On the cloudifying telecom side, they're seeing growth in customers using their Lumen Connectivity Fabric, or LCF, more port sales, more services being sold per port, moving away from just one service per connection.
All right, that's the enterprise side. What about the big AI bet? Is that paying off yet?
This is definitely the most eye-catching part. Lumen has signed $8.5 billion in deals for what they call Private Connectivity Fabric, or PCF. These are with hyperscalers, big tech companies.
$8.5 billion. Signed.
Signed deals. It's for network capacity specifically designed for AI workloads. High bandwidth, super low delay. They're building out 57 sites right now to support this, with the first 24 supposed to be done very soon in Q2 2025.
And these deals leverage existing infrastructure?
The initial ones, yes, which allowed them to move faster.
Is there more potential beyond that $8.5 billion?
They think so. Management says there's another maybe $3.5 billion in potential PCF deals they're negotiating right now.
Okay.
But these next ones likely involve building totally new fiber routes, so that takes longer. They estimate the total market opportunity here could be around $15 billion. So still room to grow if they can capture it.
When does this $8.5 billion actually turn into real revenue and profit?
Good question. They expect significant cash up front, at least $3 billion in payments coming in during 2025.
Cash good.
Definitely. But the full revenue and EBITDA impact will ramp up over time, probably over about 3 years from signing, as the clients actually use the capacity. They're predicting an EBITDA inflection point in 2026, and then revenue really starts picking up in 2028, 2029. And that's before any new digital stuff they might develop.
They've also announced some partnerships, right? with Google and IBM.
Yeah, key collaborations. With Google Cloud, it's about integrating cloud networking, offering direct fiber, secure connections for AI. With IBM, it's about putting IBM's Watson AI platform onto Lumen's edge cloud infrastructure, bringing AI closer to where the data is generated.
So making their network more attractive by integrating with these big players.
Exactly. Drive demand for the pipes by making them part of these broader AI and cloud ecosystems. IBM Consulting is also involved as an integrator.
What gives Lumen an edge here? It feels like a competitive space, building AI infrastructure.
They definitely have advantages. They're huge, and still expanding fiber network is number one. They're pushing the low latency aspect under 5 milliseconds at the edge, they claim. Direct connections to AWS, Google, Azure, the NaaS platform for flexibility, and built-in security.
Let's talk more about that network as a service, NaaS. How's that going?
Adoption is growing steadily. They keep reporting more customers on the LCF platform, more ports sold, more services per port. They crossed 500 NaaS customers back in May. They're really positioning it as a way for businesses to ditch rigid, old-school data center networking.
More flexible, more scalable.
That's the pitch. Agility, scalability, potentially better cost-effectiveness.
Any changes to the top to support this shift? New leadership.
They added 2 new directors to the board in May, Michelle Goldberg and Steve McMillan. Both have deep backgrounds in tech, finance, AI, cloud. Seems like a move to bring in more relevant expertise for this new strategy.
Makes sense. What about cutting costs? Turnarounds usually involve that.
Oh, yeah. They have a big target. $1 billion in annualized savings by the end of 2027. They expect to hit a run rate of at least $250 million by the end of this year, 2025.
Wow.
Modernizing systems, simplifying things, using AI for automation, and they're managing the decline of their older legacy services, either migrating customers or just managing those harvest products purely for cash flow.
So after the AT&T deal, they still have the copper network and some other mass market assets. What's the plan there?
Right. They keep the copper network in the States. They're not selling fiber in. Some analysts think those remaining assets could be worth, maybe $6 billion on their own.
Another potential sale down the line.
It's possible, yeah. They haven't ruled anything out. And interestingly, part of the AT&T deal involves AT&T giving Lumen access to its fixed wireless service, Internet Air. Lumen might resell that to its remaining copper customers.
Trying to offer something faster than old copper lines.
Mm-hmm.
Okay. Besides the AT&T sale, what else are they doing to shore up the finances?
They've been actively managing their debt. Did a refinancing through their Level 3 financing arm, pushed out maturities, cut annual interest by over $55 million. The transaction support agreement they reached also helped their near-term debt picture and gave them more liquidity, plus the cost savings program we mentioned, and focusing on those higher-margin grow products.
How are analysts viewing them now? Is the perception changing?
It seems to be shifting somewhat. Some reports from April suggested Lumen might be looking more compelling than competitors like Cogent, mainly because of this AI pivot and the big partnerships, even with the debt overhang. The narrative is moving towards AI-fueled enterprise growth potential.
What about margins? Are these new areas actually more profitable?
The margins look pretty good on the new stuff. In Q1, the Grow products had about a 77% direct margin. Nurture was lower, around 61%, and Harvest was surprisingly high at 69%, but that's likely managed tightly for cash.
And the AI deals, the PCF.
Those initial deals using existing assets probably have really good economics. Future deals are expected to have similar returns, and the whole NaaS model is built on cloud economics, aiming for more revenue with lower incremental costs as it scales.
Can you just clarify again what this private network fabric, PCF, actually is?
Think of it as Lumen's premium networking toolkit for AI. It's about providing super reliable, secure, high-speed connections needed for AI training and inference, linking clouds and data centers. Includes things like dark fiber, dedicated internet, wavelengths, on-demand Ethernet. They're branding it as the backbone of the AI economy.
And the $8.5 billion in deals shows there's real demand.
Exactly. It's validation that companies need this kind of specialized infrastructure.
And their global network underpins all of this.
Absolutely. That existing global reach is the foundation for PCF, NaaS, the edge computing with IBM. Everything relies on that extensive fiber footprint.
Okay, so for someone tracking Lumen, maybe considering an investment, what are the absolute key things to watch over the next year or two, the milestones?
All right, number 1, keep watching that grow segment revenue. Needs to keep climbing.
Right.
Number 2, PCF execution. Are they hitting those construction timelines? Is the revenue starting to show up in the numbers, especially ramping up from 2026?
Okay.
3, converting that remaining PCF pipeline, that $3.5 billion potential. 4, NaaS adoption, more customers, more ports, more services per customer. That needs to keep growing.
On it. What else?
5, cost savings. Hit that $250 million run rate this year. Show progress towards the billion-dollar goal. 6, EBITDA inflection. Need to see it start growing again, hitting that $3.5 billion plus target for 2026.
And cash flow.
Yeah, number 7, free cash flow. Hitting the $700-900 million guidance for 2025 is important, but also keep an eye on the S&P projection about potential negative cash flow in 2026. Need to see how that plays out.
Okay.
8, debt and leverage. Getting down to that 3.9x target post AT&T deal and showing a path to get below 3x eventually. And finally, number 9, watch the legacy revenue. It needs to stabilize, or at least the decline needs to slow significantly.
That's a comprehensive checklist. Okay, let's dig into the recent financials a bit more. Thinking about post AT&T, how was Q1 2025 overall?
Q1 revenue was $3.182 billion. That actually beat analysts' expectations, which was good news. Still down 3.3% year over year, though.
Driven by that Grow segment strength.
Yeah, Grow was up nicely, but the mass market segment, which includes the part being sold, was down. So a mixed bag, but slightly better than feared on the top line.
And profitability, EBITDA.
Adjusted EBITDA was $929 million, a 29.2% margin. Down a bit year over year, but they stuck to their full year guidance of $3.2 to $3.4 billion and are still pointing to growth next year over $3.5 billion in 2026.
Okay, let's revisit the debt picture. How much is it right now, and what's the management strategy beyond the AT&T sale?
As of the end of March, total debt was somewhere between, say, $17 billion and nearly $18 billion, depending on how you count it.
Still a big number.
Huge. The AT&T deal is crucial for getting that leverage down to the 3.9x target. Long-term, the CFO wants to get under 3x. They've been working on maturities, pushing them out past 2029 mostly. That level 3 refinancing helps save interest costs, too.
So the strategy is asset sales, EBITDA growth, cost cuts, and refinancing.
Pretty much sums it up. It's a multi-pronged approach needed to tackle that $17 billion mountain. Analysts generally agree the AT&T deal alone should knock about 1 turn off the leverage ratio.
What about free cash flow and investment, and any chance of dividends coming back?
Q1 free cash flow was $354 million. They're guiding $700 to $900 million for the full year 2025. The AT&T deal should boost that by $1.3 billion annually going forward from the CapEx and interest savings.
But S&P is cautious about 2026.
Right. They see potential for negative free cash flow in 2026, possibly due to timing of AI payments and continued high CapEx for the builds. 2025 CapEx guidance is $4.1 to $4.3 billion. That includes the PCF investment. That should drop by about $1 billion a year after the AT&T deal closes.
And shareholder returns,
Yeah.
dividends, buybacks.
Doesn't look like it's on the table right now. The focus is debt reduction and investment. Their buyback program expired last year, and they didn't use it much recently. They did get approval for a reverse stock split, but that's more about managing the share price level.
How's the market valuing Lumen now? Does it reflect the turnaround potential or the debt risk?
It's still valued pretty low compared to peers. The forward price-to-sales ratio was around 0.31x recently, much lower than Verizon or AT&T.
So skepticism remains.
Yeah, the market seems wary about the debt and whether they can truly execute the turnaround. But, if they do succeed with the AI and enterprise strategy, that low valuation could mean there's significant upside. It's a show-me story.
What are the key metrics management is watching?
They're focused on EBITDA growth, free cash flow, that grow revenue number, NaaS adoption, hitting cost savings, and bringing down leverage. Those are the internal gauges.
They lost money in Q1 on a net basis, right?
Yeah, reported a net loss. They put that down to transformation costs, investments in growth, cost of disconnecting old services, things they argue are necessary for the long term, even if they hurt the bottom line short term. They emphasize beating the consensus estimates for revenue, EBITDA, and free cash flow in Q1.
And interest payments remain high for now.
Yes. Projected net cash interest for 2025 is $1.2 to $1.3 billion. That $300 million annual reduction kicks in after the AT&T deal closes.
Looking forward, then, what's the target revenue mix? And what's their real competitive advantage, their moat?
The mix is definitely shifting hard towards enterprise, especially AI services, PCF, NaaS, cloud connectivity. The moat they're trying to build is based on that expanding modern fiber network, the low latency performance, direct cloud connections, the flexible NaaS platform, and integrated security. They want to be seen as the top dog for AI-ready infrastructure.
And the market outlook supports this focus.
Generally, yes. Demand for bandwidth, low latency, sophisticated enterprise networking, especially for AI, is definitely growing. Their cloud partnerships put them in a good position to tap into that.
But risks remain. What are the big challenges?
Execution is number one. This is a complex turnaround. Managing the debt is still critical. Competition is fierce. Balancing the decline in legacy revenue with growth in the new areas is tough. Hitting those cost savings targets, converting the PCF pipeline, and that potential 2026 free cash flow dip S&P flagged is a concern. Lots of hurdles.
So to track their progress, what are the absolute must-watch KPIs for investors?
Okay, quick recap. Grow, revenue growth rate, PCF deal closures, and crucially, the revenue recognition timing. NaaS adoption metrics, customers, ports, services, cost savings achievements, EBITDA and free cash flow trends, especially relative to guidance and that 2026 question mark, and of course, debt reduction and leverage ratio improvements.
Excellent. That really covers the landscape for Lumen. So just to summarize, for everyone listening on StockExplorers, we've got a company making a massive strategic pivot.
Mm-hmm. Selling off consumer fiber to AT&T, using the cash primarily to pay down debt, and refocusing squarely on the enterprise market, particularly AI infrastructure.
They're showing some promising early signs in that grow segment and have landed huge AI-related deals. That $8.5 billion PCF figure is impressive.
Definitely gets your attention. But the challenges are very real. Execution risk, the massive debt load, intense competition, managing the legacy decline. It's not a guaranteed success.
So for potential investors, it's really about closely watching those key milestones we laid out.
Absolutely. Is the enterprise growth sustaining? Are the AI projects delivering revenue? Are costs coming down? Is the balance sheet improving? Those are the proof points needed.
Which brings us to our final thought for you to chew on. In this incredibly fast-moving tech world, can Lumen truly become a leader in AI infrastructure while juggling its legacy business and that significant debt?
Yeah, that's the multi-billion-dollar question, isn't it? Time will tell, but the path they're on is certainly one worth watching closely.
Indeed it is. Thanks for joining us for this deep dive. Don't forget to subscribe, give us a like if you found this useful, and hit those notifications so you catch our next analysis.